Okay guys, welcome to Module 1. In this module, our expert will give us an overview of bank loans. So, get ready to take some notes and let's jump right in.
Module 1. Introduction to Startup Capital. Bringing your business idea into life is easier said than done. At the end of the day, you have to understand that experience plays a major role in making that great idea work. If you're unfamiliar with the ins and outs of starting a small business, turning your dream into reality can be challenging. Simply put, starting a business involves several factors including staff, location, inventories, suppliers, startup costs, and more. However, these factors can only be put into consideration once you've secured startup capital. In this training, you'll learn about the different options for small business to raise capital. In Module 1, we'll look at the different types of loans. Module 2 will focus on investors and how to choose the right one for you. Finally, Module 3 will provide you practical alternatives to raise capital from within your community. To start things off, let's take a look at the types of loans that a small business can apply for. Bank loans. If you're just starting out, then this may seem to be the best option for you in securing capital. It's a logical and practical step to take, given that bank loans often have the lowest interest rates. There are two main types of bank loans: fixed and flexible. Fixed bank loans refer to loans that have an agreed payment schedule and a defined interest rate. On the other hand, flexible bank loans are loans that have adaptable rates. The rates are determined depending on your business and financial needs. With either type of loan, the repayment term can be between 1 and 15 years, depending on the loan amount. Interest rates range from 7% to 12%, but can be subject to change depending on a variety of factors, such as the loan amount and current market conditions. However, securing a bank loan can be very daunting for small businesses. This is because banks have drastically reduced their loan approval rate, citing failure as the main reason. For a bank loan to be approved, you need to comply with a number of requirements. These include credit history, financial statements, collateral, cash flow, and, of course, business experience. These requirements are vital when it comes to securing your loan. A secured loan, as the name implies, requires that you offer an asset or security that the bank can seize if your company fails to repay in an agreed time frame. Although secured loans offer higher amounts and lower interest rates, they can only be secured by companies with significant assets. In short, applying for bank loans is a tough choice for small businesses. SBA loans. The Small Business Administration, or SBA, is a cabinet-level federal agency in the U.S. that offers extensive assistance to small businesses. Describing their purpose, this is what their website has to say. The SBA is the only cabinet-level federal agency fully dedicated to small business and provides counseling, capital, and contracting expertise as the nation's only go-to resource and voice for small businesses. SBA does not offer loans, but instead, it works with its partnering lenders, community development organizations, and micro-lending institutions. To ensure protection for both borrowers and lenders, all lenders are subject to verification, and all loans should meet certain conditions to be approved. SBA loans are only available to businesses around the U.S. or its territories that do not have any other means of securing startup capital. The SBA offers 4 kinds of loans: 7A loans, microloans, 504 loans, and disaster loans. Each of these loans has specific uses. When applying for one of them, you must state what you plan to do with the money. 7A loan. A general small business loan, commonly known as a 7A loan, is the most common type of SBA loan and has the widest range of uses. It includes financial help for businesses with special requirements. 7A loans can be used for startup costs, purchasing land and real estate, equipment, refinancing debt, and more. To become eligible, businesses must operate for profit, engaged in the U.S., have reasonable owner equity to invest, and use alternative financial resources such as personal assets. $5 million is the maximum loan amount with no minimum amount. Interest rates are negotiated between the borrowers and the lender, but should meet the SBA maximums or conditions. Microloan. The microloan program is a type of SBA loan that is typically used to start or expand a new business, including nonprofit community-based organizations such as child care centers. Microloans cannot be used to pay existing debts or purchase real estate. Eligibility depends on the intermediary lender's own lending and credit requirements. However, most intermediaries will require some type of collateral and personal guarantee of the business owner. Interest rates for microloans are between 8% and 13%, having 6 years as the maximum repayment term. 504 loan. A real estate and equipment loan, more commonly known as a 504 loan program, is a type of SBA loan that is used to finance a startup business while promoting business growth and job creation. 504 loan funds can be used for different purchases, such as existing buildings or land and land improvements. It's also used to fund the construction or renovation of facilities. 504 loan funds are also used for refinancing debt for business expansions. The 504 loan program offers both immediate and long-term benefits that business owners can surely take advantage of. Top-level benefits include 90% financing, fixed-rate interest rates, longer loan amortization, no balloon payments, and improved cash flow resulting in more savings. In order to qualify for this loan, your business must be operated for profit and should comply with the size standards set by the SBA. You should have tangible net worth of more than $15 million and an average net income of $5 million or less for the preceding 2 years prior to application. The maximum loan amount is $5 million, but small manufacturers or energy projects may qualify for $5.5 million debenture. Small businesses and lenders can contact a Certified Development Company or CDC in their area for more additional application requirements. Disaster loan. A disaster loan is a low-interest loan provided by the SBA designed to help businesses and homeowners recover from declared disasters. There are 4 types of disaster loans: physical damage loans, mitigation assistance, economic injury disaster loans, and military reservist loans. To be eligible for a disaster loan, businesses of all sizes must be located in declared disaster areas and have been affected by declared disasters, including civil unrest and natural disasters such as hurricanes, flooding, earthquakes, wildfires, and even pandemics. Disaster loans can be used for working capital or financing normal operating expenses, paying losses not covered by insurance, or funding from the Federal Emergency Management Agency, FEMA, as well as paying business operating expenses that could have been met had the disaster not occurred.